Now, tonight we are looking at capital reconstruction. Let me quickly say that for some of us that will be taking case study, this topic is an integral part of cases. It's an integral part of case study. Or I can decide to take a case from capital reconstruction. What am I trying to stress here? The knowledge you are going to get here is equally important for your case study class. All right. A quick recap of our first class. We look at corporate failure. Why do companies fail? What can we do to avert companies from failing? We explained that the objective of a company is to maximize the wealth of the owners. And a situation where a company cannot consistently maximize the wealth of the owners, then we said there's corporate failure. We look at causes of financial distress. Revenue failure. If a company is not making enough revenue, that company will experience financial distress. Financial distress will result in corporate failure. And corporate failure will lead to eventual collapse of the company. We look at cost failure. Under causes of corporate failure, cost failure, failure in asset management, failure in liability management, failure in capital management. This could result in corporate failure. Please, somebody is conflicting with my class. Gloria, please mute. Thank you. Now we explain these 5 points as the main causes of financial distress. And once there's financial distress, the company will experience corporate failure. Corporate failure will eventually result in company's liquidation. We look at the symptoms of corporate failure and how to avert corporate failure. Now tonight, our topic is capital reconstruction and business reorganization. Now the question is, if a company is experiencing symptoms of corporate failure, if a company is experiencing symptoms of corporate failure, it is the duty of the company's directors to invite the owners of the business. Just listen. It's an interesting topic. If a company is experiencing symptoms of corporate failure, that means the company is experiencing financial difficulties. It is the duty of the company's directors to invite the owners of the business and inform the owners of the business about the financial health of the business. The directors must come up with solution of what they think the company can do to avoid eventual collapse. If you are inviting the directors, you must come up with possible solution that you feel that the company can do to avoid eventual collapse. There are several solutions that could be profiled. There are several solutions that could be presented to the owners of the business. One of these solutions is what we call capital reconstruction. One of these solutions is what we refer to as capital reconstruction. What is capital reconstruction? A capital reconstruction is a major reorganization of the company's capital structure. A capital reconstruction, is a major reorganization of the company's capital structure. Capital reconstruction is usually carried out when a company is experiencing financial difficulties. Capital reconstruction is usually carried out when a company is experiencing financial difficulties and the possibility of eventual collapse of the company is very high. Capital reconstruction might involve asset revaluation. A capital reconstruction might involve asset revaluation, raising new capital for the business, conversion of debt capital into equity capital, conversion of equity shares from one form to another form of equity. And 5, existing shareholders might be required to relinquish all their shares and accept a smaller quantity in the reconstructed companies. I'm going to restate that point. Please be mindful. Capital reconstruction might involve revaluation of assets. Please, you can note this down. It is my belief that what you write with your hand, you learn faster. Capital reconstruction might include or might involve revaluation of assets, raising new capital to support the business. Number 3, conversion of debt capital to equity capital. Number 4, conversion of equity shares from one form to another form of equity. Then number 5, the existing equity shareholders might be required to relinquish all their shares or part of their shares and accept a smaller quantity of new shares in the reconstructed company. Please note this, because these 5 points to calculation. The purpose of capital reconstruction. The purpose of capital reconstruction is to find a way of allowing the company to continue in business and avoid insolvency and liquidation. I will take that again. The purpose of capital reconstruction is to find a way of allowing the company to continue in business and avoid liquidation. Please allow me 1 minute. Continue the class. Now, okay, I'm back. Sorry, I just have to quickly attend to. Let's get to the business. Now, the purpose of a capital reconstruction is to find a way of allowing the company to continue in business and avoid insolvency and liquidation. A capital reconstruction is worth considering. A capital reconstruction is worth considering only if, 1, it is likely to be more beneficial to all the parties concerned. For example, it's a known fact that Heritage Bank has been declared not fit financially. That means that company is troubled. Heritage Bank PSC is in financial crisis. Now, if the company's management is looking at capital reconstruction. We are only going to talk of capital reconstruction if it is likely to be more beneficial to all the parties concerned than the liquidation of the company. We shall be talking of capital reconstruction for Heritage PSC. If capital reconstruction is more beneficial to the stakeholders than the liquidation of the company, that is point number one. What it means is that if you are looking at capital reconstruction for a company, that capital reconstruction must be beneficial to the stakeholders involved than to liquidate the company. So for Heritage PSC, the choice is between reconstruct the company's capital structure or liquidate the bank. We are only going to talk of reconstruct the company if reconstruction is more beneficial to the stakeholders of Heritage PSC. Who are the stakeholders? The shareholders, stakeholder one. Other providers of capital, stakeholder two. The suppliers to the company, stakeholder three. We are only going to look at reconstruction for Heritage PSC if reconstruction is more beneficial than to liquidate the bank. Point number two, we are going to consider reconstruction if the reconstructed company has a good chance of surviving and restoring itself to profitability. Please look at point number two. We are only going to consider reconstruction if the reconstructed company has a good chance of surviving and restoring itself to profitability. In other words, Heritage PSC, we only be talking of capital reconstruction if there's possibility that if we reconstruct this company can survive and return itself to profitability. Otherwise, we should not bother about reconstruction. Reconstruction is only beneficial. Reconstruction will be beneficial to the parties involved if it is likely to result in getting more cash or getting more value from the reconstruction. Please asterisk these points in your material. You are only going to talk of reconstruction, or you are only going to accept reconstruction if that reconstruction will result in getting more values to the owner or getting more cash to the owner than liquidating the company. That means if you are faced with question on reconstruction, you are going to consider two positions. If I reconstruct this company, what will the stakeholder benefits? Alternatively, if I liquidate this company, what will the stakeholder benefits? We are not going to compare the two benefits, and you now select the one that is giving you the higher benefit. Is that clear, please? All right. The principles of capital reconstruction. There are three fundamental principles of capital reconstruction. There are three fundamental principles of capital reconstruction. One, no creditor must be made worse off under reconstruction than they will be under liquidation. Please note, receivership is also known as liquidation. No creditor should be made worse off under reconstruction than they will be under liquidation. This is because the agreement of the creditors is required for a reconstruction to take place. That's point number one. Principle number two, we call it post-reconstruction profitability. It means that there must be a good chance that the company will be financially viable and profitable after reconstruction. Post-reconstruction profitability. There must be a good chance that if we reconstruct this company will be able to return itself to profitability. Please note that it makes no sense to go to the trouble of reconstructing a company and since the company will now eventually collapse. That is principle number two. If you ask me, for central bank to declare Heritage Bank non-fit, the bank management must have tried everything possible to save the company from collapsing. But it is very possible that they noted that the bank does not have good chance of returning to profitability. Hence, they decide to allow the bank to die. All right, that's by the way. Then principle number three, it must be able to be demonstrated that the reconstruction scheme is fair to all parties. The reconstruction must be fair to all parties. Although the concept of fairness is subjective. The principle of fairness is needed to assess if that reconstruction is suitable or acceptable. So please note the three principles. And let me say that examiner is not likely to ask you to write the principle. The principle is to guide your computation and decision making. When we say no creditor must be made worse off, let's take illustration to this. Assuming Heritage PSC is a company, not a bank. Assuming Heritage PSC is a company, not a financial institution. And the company obtained loan You have granted a loan to Heritage PSC to the tune of 50 million at an interest rate of 15% annually. That means Heritage PSC is supposed to pay you interest 15% annually. And at the end of repayments will be made. In the book of Heritage PSC, you are going to be part of the debt holders. In the book of Heritage PSC, you are going to be reflected under non-current liability as part of the debt holders of this company. Now, Heritage PSC has run into financial crisis. And there's no possibility of repaying your 50 million. That means you are part of the creditors to that company. You are part of the stakeholder to Heritage PSC. Now, Heritage PSC is now looking at reconstructing the company's capital structure. Please follow the illustration. Heritage PSC is looking at reconstructing the capital structure. And the company now proposed to you. The company proposed to you that we want to convert your 50 million naira loan to equity shares that are worth 25 million naira. A proposal has been sent to you that your loan, the loan you have given the company is converting this loan to equity shares. And this is subject to your acceptance, or you can decide to reject it. Now, if you accept this offer, that means the company will move you from debt holder, will now become part of the shareholders. Technically, your loan will not be repaid. Technically, you are not entitled to interest again, this interest. You will now collect only dividends. Now, your 50 million naira in loan is being converted to 25 million worth of equity. They are now asking you to accept or reject. Before you can accept the offer, you now ask yourself, if this company is liquidated and the asset realized, what am I going to get if the asset is realized? Before you can accept that offer, you are going to ask yourself, if this company is liquidated and the assets realized, what can I get? Assuming if the company is liquidated, you can get 30 million naira cash for liquidation. The question is, will you accept a reconstruction that is giving you 25 million naira equity? This is the question to the class. Will you accept a reconstruction that is offering you 25 million naira worth of equity? Please, I need response from the students. Yes, we're speaking. Mohammed, Gloria, Robbie, we're speaking.
Okay, I want to speak. Good evening, sir.
Yes, Jide.
Yes, good evening. I will need to analyze the proposal and see if I would want to convert my debt to equity.
Now look at the
What's the
proposal. Just hold on. The proposal
okay?
is that your debt that was 50 million is
Mm,
converted to equity that was 25 million. Now,
mm.
alternatively, if the company is liquidated, you can get a cash of 30 million. What are you going to agree to?
I'll take my 30 million because I'm not sure of. I will take my 30 million because I'm not sure of the company's profitability after the reconstruction.
Okay, clearly, you are going to accept 30 million because 30 million cash is more than 25 million naira equity. Let me look at the chart. Yes, Mohammed, I will reject the offer. That means that is the principle number one. No creditor must be worse off under reconstruction than they will be under liquidation. That is the principle number one. So if you are calculating, you are now looking at two alternatives. The company proposed to give me equity that was 25 million naira. You will now ask yourself, assuming this company is liquidated, how much can I realize? I can get 30 million. Say, no, I will reject reconstruction. I will accept liquidation. Liquidation is offering me more cash, more value. Is that clear, please? Once you understand this principle, calculation will not be difficult. Principle two, we should be sure that if we reconstruct, this company can continue in business and return to profitability. What are we trying to say here? You are aware that the company is in financial crisis. If you look at Heritage Bank PSC, for many years, the company has been reporting, the bank has been reporting losses. That means the bank is not making profits. Now, if you are now trying to reconstruct such company, we must have an assurance that if we reconstruct this company can return itself back to profits. Please note that. Then number three, the principle of fairness. It is the fairness that will determine whether to accept the reconstruction scheme or to reject the reconstruction scheme. We have different stakeholders, the shareholders, the debt holders, creditors, your stakeholder, banks, stakeholder. They will now decide. Employee is a stakeholder, but in this case, employee does not have too much choice. If the company is liquidated, it's for that person to go and find another job. Employee has limited choice here. Even if the company is reconstructed, They can still ask the employee, they can still reduce staff. So please note, let's move on with the class. All right, thank you for the responses. Steps involved when analyzing capital reconstruction scheme. Sorry, please, I'm trying to find. What are the steps involved? If you are dealing with capital reconstruction scheme, generally there are 6 steps. But on some question, you might not need to apply the whole 6 steps. Generally, there are 6 steps. And in some questions, you might not need to apply the system. We are going to look at the 6 steps. State the 3 fundamental principles of capital reconstruction. That means if you are dealing with that question, you must be mindful of the 3 fundamental principles of capital reconstruction. Step 2, consider situation in liquidation. That is, if this company is liquidated and the asset realized, who gets what? What will each party collect? If the company is reconstructed, if the company is liquidated and the asset disposed, cash realized, how do we distribute the proceeds from liquidated assets? Who gets what? How do we distribute the proceeds from the liquidated assets? Please note, the Bankruptcy Act specifies how the proceeds from the liquidated asset should be distributed. Please note, the Bankruptcy Act specifies how the proceeds from the liquidated asset should be distributed. Now, what this means is you cannot use your personal initiative to distribute the proceeds from liquidated assets. There's a law that guides how the proceeds should be distributed. And you are going to follow the law if you are dealing with capital reconstruction involving liquidation. Is that clear, please? The law says in priority of distribution, you are going to start with preferential creditors. Go and check. Who are the preferential creditors? Please note, look at what we are discussing. I'm about to discuss this point here. And this point here is very key to calculation. This point is very key to computation. You are going to start with preferential creditors. Who are the preferential creditors? Unpaid tax, unpaid wages and salaries, unpaid pensions, unpaid taxes. This category constitutes preferential creditors. Now, what it means is that if you are dealing with a question and you have preferential creditors, and that company is to be liquidated, you are going to look at it. The proceed will start with preferential creditors. You have to settle them. It is not impossible that a company that is troubled, for example, like Heritage Bank, it's not impossible that this company has not been paying staff wages for some time now. They have not been paying their staff salary, or they are just paying partial salary. They are owing the staff a lot of arrears. The law recognizes employees' consent. That pay them. Pay your pension, pay your taxes. Now, number 2, fees charge secure creditors. Please, this number 1 and 2, there's a bit of conflict. And we are going to resolve the conflict. There's a bit of conflict created by the law. There's a conflict created by the law. An accountant, we are going to resolve it here. Fees charge secure creditors. Please, if possible, you can take this illustration down. It will help your understanding. I'm going to explain fees charge secure creditors with illustration. Now, assuming our company in question, Heritage PSC, is assumed not to be a bank. Heritage PSC, let's assume, approach a bank to obtain loan. Heritage PSC approach a bank, for example, GT Bank, to obtain a loan of 50 million. And the company, Heritage PSC, has properties at different locations. Our company, Heritage PSC, we have a property located at Ikeja. Another property located at VI, Victoria Island. Another property located at Abuja. Our company has 3 properties located at 3 different locations. Ikeja, Victoria Island, and Abuja. We now decide to use our property located at Abuja as a collateral for the loan obtained from GT Bank. We now decide to use our property located at Abuja now as a collateral for the loan we are obtaining from GT Bank. Look at it. A loan of 50 million and the property located at Abuja is used as a collateral for that loan. That is fees charge. By way of definition or explanation, fees charge is where a liability is secured on a specific asset of a company That is fixed charge. Where a liability is secured on a particular asset of a company, that is called fixed charge. A liability is tied as security to a particular asset of a company. That is called fixed charge. Is that clear, please? Now, what are the implications of fixed charge? What are the implications of fixed charge? In the event that Heritage PLC cannot pay back the loan, in the event that Heritage PLC will not repay the loan obtained from GT, and the company is being liquidated, GT Bank will have a direct claim to that property located at Abuja. GT Bank will realize is 50 million from that property located at Abuja. In the event that that property proceed is not sufficient to repay GT Bank loan, in the event that that property, if that property is disposed and we only realize 40 million, that 40 million will be applied directly to pay GT Bank loan. GT Bank will not have any rights to other property of the company. In the event that we have disposed that property in Abuja and we only got 40 million, that 40 million cannot be used for any other person. It must be given directly to GT Bank. You cannot even give it to preferential creditors. Is that clear, please? You cannot even give that proceed to preferential creditors. That proceed must go straight to GT. Now the question will also be, how will GT be able to claim the balance of 10 million? Because GT has given a loan of 50 million. Now the company is in financial crisis. The company is to be liquidated. And we can only realize 40 million from the assets. Like I said, GT Bank will not have any right to other assets. But GT will now come and rank. GT will now rank alongside other unsecured creditors. That means from position number 2, GT Bank will now move to position number 5. It becomes part of unsecured creditors. It's clear. Is that point clear?
Yes, sir.
Let's note. Now, the second question is, what happens if we realize like 80 million from that property? In that case, you are going to give GT Bank 50 million full. Remaining 30 million will be returned back to be shared by other parties. All right, the next place. Now, the conflicts. If you are giving preferential creditors in a question, and you are giving fixed charge in a question, please note, any asset that is tied to fixed charge, you cannot apply it to pay preferential creditors. Please note, any asset that is tied to fixed charge cannot be applied to preferential creditors. All right. Floating charge. For floating charge, secure creditors, it's a situation where a liability is not tied to a particular asset. The liability is secured on all the company's assets. In this case, if there's liquidation, the liability will continue to float from one asset to the next asset until the total liability is recovered. Is that point taking place? The liability will continue to flow until you are able to recover the full amount. Redundancy payments. When we say redundancy payments.
I'm sorry, sir. Please, can you talk about the floating charge again, sir?
Eniola. All right, no problem. Let's illustrate that. Again, please, can you mute any? Let's illustrate that. Again, assuming our example we gave, Heritage PSC. This company approached a bank to obtain a loan of say 100 million. And you are now obtaining this loan under floating charge contract. What it means is that that loan is on all your assets. What it means is that that loan is secured on all the assets of the company. Your properties, your properties, your machinery, your car, all liability is secured on all the assets. Now, in the event that that company cannot pay the loan back, and the company is to be liquidated, GT Bank will have a right to move from one asset to another asset in order to recover all the loan he has granted the company. In this case, if GT Bank moves to a first asset, you realize 50 million. You are going to move to the next asset, you realize 30 million. You are going to move to the next asset until you realize the total amount of loan you have given the company. That is floating charge. Is that point clear, please? Any and others? Is it clear, please?
Yes. Thank you, sir.
All right, thank you. It's even better you ask. Some they will not really ask. They will go and read. But asking help a lot of people. Then the next point, redundancy payments. Now, when we say redundancy payments is payments for laying off employees, for terminating their appointments. You are making them redundant. Then you can make some payments, maybe like 1 month or 2 months salary in nil. Definitely, if a company is liquidated, the employees has been made redundant. If you liquidate a company, the employees automatically has been rendered redundant. They have been returned to the labor market. It is not impossible that the company may propose to pay the employees maybe 1 month or 2 months salary to take care of the employees while they are looking for another job. That's what we call redundancy payments. If the question makes provision for redundancy payments, then after you have treated number 1, number 2, number 3, you are going to now, once you liquidate the company, then the proceeds from that company, you have settled your preferential creditors, you have settled fixed charge, you have settled floating charge, then you are still having cash remaining. Then you are going to settle redundancy payments if there is provision for it. Next, unsecured creditors. These are creditors without security to their loan, or no collateral. A good example is trade creditors. The trade creditors, they are largely unsecured. If bank give you overdraft, bank might not ask you for security. Bank overdraft, that becomes the next creditor to settle. Then you now move to preference shares. The preference shareholders. Then the last person is ordinary shareholders. Please note, some of these, some stakeholders may not collect anything if a company is liquidated. In most cases, shareholder will not collect anything because the money will not be, the proceed will not be sufficient to even pay shareholders. So this will happen in your step 2. Your step 2 is where you do a lot of computation. Your step 2, you are going to do a lot of computation. Step 3, you are going to look at the cash position of the reconstruction scheme. Check how much finance required by the reconstruction. How much finance do we require to implement the reconstruction? You are going to compare this with the cash required to find cash available. You are going to look at it. Cash required to finance reconstruction and cash available with you. Cash required, available and required must be equal, or available must be more than required. Hello? Availability and requirement must either be equal or availability must be more than requirement if we are to execute reconstruction scheme. For example, we are planning to reconstruct Heritage PSC and we require 500 million for reconstruction. That means we must have available 500 million. If availability is less than requirement, you are going to go back to that reconstruction scheme. There's a problem. If availability is less than requirements, you are going to go back to that reconstruction scheme and redefine it. Meaning you are going to go back and rework it. It cannot work. Number 4, text for post-reconstruction financial profitability. You are going to text, if we reconstruct this company, can this company continue in business and make profits? You are going to text for post-reconstruction profitability. In carrying out this text, you might reconstruction earnings per share. You are trying to text. You might calculate post-reconstruction price earning ratio. This topic, a bit digression, it's a technical topic. It happened in practice, accountancy practice. Like what we are with Heritage now, accountant we set to work. Are we going to liquidate the bank? Accountants we set to work. They will now look for all the assets of Heritage. We need to sell these assets. They will now look for all the stakeholders. Too bad. Depositors are also supposed to be part of the stakeholders. But when they are liquidating, how much will depositors get? Step number 5, evaluate the attitude of the creditors group. When we say evaluate, this is where you text for the principle of fairness. This is where you text for the principle of fairness. You are going to check individual stakeholder. You are going to pick the shareholder. If this company is reconstructed, what will the shareholders benefit? If this company is liquidated, what will the shareholders benefit? You are not going to ask yourself, is this reconstruction fair to the shareholders? Then you move to the next person, the debt holders. If this company is reconstructed, what will the debt holders benefit? If this company is liquidated, what will the debt holder benefit? You now compare and make your conclusion. Is this reconstruction fair to the debt holders? Then you move to the next person, bank or trade creditors. You continue to move. You are going to be checking. You are going to be comparing two things. Reconstruction against liquidation. Then the last step, you are going to draw your conclusion. And you are going to tell us if the reconstruction is good or we should reject it. Those are the 6 steps that are very key to question of capital reconstruction. All right. The principal explanation. Any question before we move to calculation? Any question, please? All right. Let us look at question number 1. If there's no question, please may I request anybody can read the question number 1? If I'm not asking for too much, let me be sure that the class we are together. Question number 1, Diamond Nigeria Limited. Any volunteer? Any volunteer willing to read for the class? No volunteer? I want the student to be part of the class.
Okay, illustration 1.
Okay.
The latest statement of financial position of Diamond Nigeria Limited is summarized below. Non-current assets are...
Allow me to put it up.
Okay.
Yes, you can go ahead. Okay.
Okay. Non-current assets at net book value 28,500,000.
Go on.
Then current assets, you have inventory and work in progress 17.5, receivables 9 million, total 26.5, less current liabilities, unsecured payables 20 million, bank overdraft unsecured 8 million. That's a negative total of 28 million. Then the working capital 1.5, total asset less.
1 minute. You observe that this company is running at negative working capital. That means something is wrong. All right, you can go ahead.
Okay, so the working capital negative 1.5, total assets less current liabilities 27 million. Liabilities falling due after more than 1 year, 10% secured debentures, that's 50 million. The net assets 12, capital and reserves, called up share capital 20 million, statement of profit or loss, that's a loss of 8 million, and it gives us a balance of 12 million.
Okay, thank you. Yes, you can continue, ma.
Diamond Nigeria Limited's called up capital consists of 20 million Naira ordinary shares issued and fully paid. The non-current assets comprise freehold property with a book value of 15 million and plant and machinery with a book value of 30.5 million.
Just 1 minute, please. Just 1 minute, please. Just 1 minute. You observe that examiner tried to explain the 28.5 million. It comprises freehold property, book value 15 million, plant and machinery, book value 13.5. That's explained the 28.5 million non-current assets. Thank you. Annie, please go ahead.
Okay, so the debentures are secured on freehold property. In recent years, the company suffered a series of trading losses, which have brought it to the brink of liquidation. The directors estimate that in a first sale of the assets, they will realize the following amounts: freehold property 10 million, plant and machinery 5, inventory 8.5, receivables 8.5. The cost of liquidation are estimated at 3.850 million. However, trading conditions are now improving, and the directors estimate that if new investments in plant and machinery consisting 12.5 million were undertaken, the company should be able to generate annual profits before interest of 8,750,000 naira. In order to take advantage of this, they have put forward the following proposed reconstruction scheme. Number one, freehold property should be written down by 5 million, plant and machinery by 5.5 million, inventory and work in progress by 4 million, and receivables by 500,000. Two,
Good.
the ordinary shares should be written down by 50 million, and the debit balance and statement of profit or loss written off. Three, the secured debenture holders would exchange their debentures for 7.5 million ordinary shares and 6.5 million naira. 14% unsecured loan stock repayable 5 years time. The bank overdraft should be written off, and the bank should receive 6 million 14% unsecured loan stock repayable in 5 years time as compensation. 5. The unsecured payable should be written down by 25%. 6. A right issue of 1-for-1 at par is to be made on the share capital after the above adjustments have been made. And 7. 12 million naira, 500,000 will be invested in new plant and machinery. Required, prepare the statement of financial profit of the company after the completion of the reconstruction. B, prepare a report including appropriate calculations discussing the advantages and disadvantages of the proposed reconstruction from the point of view of 1, the ordinary shareholders, 2, the secured debenture holders, and 3, the bank.
All right, thank you. Thank you so much.
You're welcome.
The question, in fact, the way she read is fine. Like, I'm just happy with me ready. The question has been served. We are to prepare the statement of financial position of the company after the completion of the reconstruction. So what we are required to prepare is post-reconstruction statements of financial position. That is, if this company is reconstructed, how would the company balance sheet look like? Prepare that for us. In the course of reading the question, she also mentioned something. I didn't want to pause at that point. Look at it. The debentures are secured on the freehold property. Fixed charge, where a liability is secured on a particular asset of a company. That is fixed charge. We are coming back to that. Let us attempt to the first requirement. Right? Just 1 minute. I need to equip my digital pad. We can solve the question. Just 1 minute. Our attention will now be on the proposed reconstruction scheme as an adjustment. Please, I will be sharing the whiteboard shortly. Our whiteboard I will be sharing shortly. Yeah. Please confirm you can see my whiteboard being shared. Hello?
Not yet, sir.
Not yet, okay. Now, please confirm you can see the whiteboard.
Yes, sir.
Okay, great. We are going to navigate between this board now. Okay, Mohammed. Now we are going to look at the adjustments. Look at the reconstruction scheme 1. Freehold property should be written down by 5 million. Plant and machinery written down by 5.5 million. Inventory written down by 4 million. And receivables written down by 500,000. Let us move to this adjustment. I'll come here. Working 1. Working 1. Please look at it. I will start with property. In the question, we are told that the book value of this property is 15 million. The book value is 15 million. Assuming 30 up. Examiner says, write this down by 5 million. Write down. That means write 5 million off. Less 5 million. I'm left with what? Write down by 5 million. What do you have here, please? This becomes 10 million.
Yeah.
Then, my plants. Plants.
Excuse me, please.
And machinery.
I have a question.
Yes, please go ahead.
Okay. You know, from the question, I'm looking at the balance sheet or the statement of financial position, right?
Yeah.
And we have non-current assets at net book value of 28,500. That is
Okay.
up here, 28,500. That is where I'm starting from, the 28,500. So if we now come down, what we're writing down right now, we've confirmed that the entire assets that make that 28,500 is in this question here before the write down starts, right? That 28,500, is it composed of all the assets here before the adjustment that we want to carry out?
Hold on. That 28,500, look at it, please. Look at it, please.
I just want to be sure it's here first before we start calculating.
Look
okay, that is 15 plus 13,500. Okay.
Yes.
Before the write down, so that somebody can understand the adjustment we are doing proper.
Is that clear, please?
Okay.
Are we on the same page now?
Yes.
Okay, great. So we now want to write it down. Okay. Plants and machinery book value. How much, please? 13.5. Is that not? The book value is 13,500. Write down by how much, please? Write down by how much? Let me go back to the question. I want to have the class together. Examiner says, let me have the class together. Please look at it again. Property should be written down by 5 million. Plant and machinery written down by 5.5. Inventory and work in progress by 4 million. Receivables by 500,000. Please, can we note this 4, please? So as to save time of coming and going back. Can we note it, please?
Yeah, noted.
All right, great. Great. So we move back to that whiteboard. So I'm going to write down machinery by 5.5. I'll come here, less 5.5. Minus 5.5. I'm left with what, please? Please, let's do the working. Get your calculator already. How much, please?
8 million.
8 million. I will move to inventory. Inventory and work in progress. What is the book value of our inventory? Please check the financial statement you are giving.
17,500.
Let's go back to that statement. How much?
17,500.
Good. So we are going to write down by 4 million. I'll come here. Just 1 minute. 17,500 less write down 4 million. I'm left with 13,500. Next piece. My trade receivables. What is the book value of our receivables? When we say book value, amount in the statement of financial position is known as the book value. Look at it, please. Receivables,
9 million.
how much, please? 9 million.
9 million.
9 million. Oh, sorry. 9,000 less write down 500,000.
500,000.
Write down, that is 500. I'm left with 8.5. Any question to this, please? Any question to this, please? This is what we call revaluation of assets. Recall, I said, we said capital reconstruction can take different forms. It might include revaluation of assets, introduction of new capital to the business, conversion of debt capital to equity, conversion of equity from one form to the other. Existing shareholders may be asked to relinquish part or all their shares. What you have done here is what we call revaluation of assets. The company is trying to revalue its assets. because the company is not doing well. There's no point carrying assets in your book that you are not sure of getting the value. We have adjusted note 1. Is that clear, please? Okay, let's look at note 2. The ordinary shareholder, the ordinary shares should be written down by 15 million. Look at it. Existing shareholders can be asked to relinquish their shares. That means we are going to write down share capital by 50 million naira. And the debit balance on the statement of profit or loss written off. Let's go to this. Look at the statement. Call up share capital is 20 million. Examiner says write it down by 15 million. Technically, we are left with 5 million. If I'm doing the working out, immediately, if I go to that working, if I come here, I'm doing this, or we are doing this to enhance understanding. You know, in your exam, you are going to be conscious of your time, and you have to move fast. If I come here now, I can still manage here. I will say, working 2. But I require a bigger space for this working. This will involve a lot. So allow me to share the second material, the second whiteboard. Okay, please confirm you can see the new whiteboard being shared.
Yes, sir, we can see it.
All right, I will now come here. This working will involve plenty things. I don't want to read that small place. I'll come here now. Working 2. Share capital. I have quantity, price, and value. We have the shareholders. We have 20,000. That is 20 million, please. Assume 30. Nominal price per share as given 1 naira. The value is 20 million. Now, examiner says write down by 15 million. Write down 15 million shares to be written down. Naira value 15 million. In brackets, also brackets. That means if this proposal is accepted, we are going to have 5,000 shares. The naira value is 5,000 naira. The nominal price per share is 1 naira. This is the original shareholder. The original shareholder. Their investments that are worth 20 million has been reduced to 5 million under reconstruction proposal. The investment that are worth 20 million has been reduced to 5 million under reconstruction proposal. You know, examiner says, prepare statement of financial position after the completion of the reconstruction. So you are going to prepare it. You are going to do all your workings. Then you are now going to go to that statement and prepare it. All right. Let's go to note number 3. Please feel free to ask questions. Look at note number 3. The secured debentures holder who exchange their debentures for 7.5 million naira ordinary shares. Before I go further, let me explain that. Debentures is a debt. We are now converting debt to ordinary shares. The secured debentures holder would extend their debentures for 7.5 million ordinary shares and 6.5 million 14% unsecured loan stock, repayable 5 years time. That means a secured debt is being converted partly into ordinary shares and partly into unsecured loan, unsecured debts. And this debt will be repaid in 5 years. Let's go and look at debentures holder position. If you look at the statement, secured debentures holder is 15 million. Now the company is proposing to convert this 15 million debt to ordinary shares that are worth 7.5 partly, and to unsecured loan that are worth 6.5. That means technically, if the debentures holder accept this offer, they are going to lose 1 million naira.
You say it right now.
Is that not, please? 7.5 plus 6.5, that is 14 million. Abi? Yes, 14. That means they will lose 1.5. In addition, they are now shareholders, partly shareholders. Let's go and do the adjustments. Let's go to the adjustment. Look at the adjustments. I will come here. Secure debentures. Converted to shares. 7,500 shares. Naira amount 7.5 million. At it. I'm placing under share capital debentures. I have converted debentures to part of ordinary shares. I will now go to working trade. I will now open 14% unsecured. Okay, that is any problem. Oh, it's not a writable area. Let me come here. Just surprise. Just 1 minute. Just 1 minute. Why is it not taken as a writable area? Unsecured is seeing it as unsecured loan. Oh, it's not taking that place. He's seen that place as not a right. Unsecured loan stocks, okay? Loan stock. We need to move on. I'll put here under this debentures. $6.5 million. Okay, 6,500. What we are saying is unsecured loan stock to debentures holder to be repaid 5 years time. Just 1 minute. Should be able to pick. Oh, sorry. No. I don't even need this. Okay. Okay. Okay, yeah. I'm wondering what is happening to my whiteboard. All right, let's go back to the. So this is settled debentures. I've converted the debt partly to ordinary shares and to another form of debt. Now, that form of debt is not secured. That is treatment of my note number 3. Oh, sorry. I'm having so many. Now, note number 4. We are here now. The bank overdraft should be written off. And the bank should receive 6 million, 14% unsecured loan stock, repayable in 5 years' time as compensation. Let's go and look at this. Please remember, this is a proposal. Is this subject to what acceptance? We are only treating the proposal as given. Let's look at this. Oh, sorry. Yeah, I want to see. Please look at the statement. Bank has given this company 8 million naira overdraft. Now, the company is proposing that let us write off the overdraft. The company is proposing to the bank, let us write off this overdraft. As a compensation, we are going to give you 6 million unsecured loan stock, at 14% interest. Whether the bank will accept or not, we don't know. But we are going to treat the proposal first. It is left for the bank to say, I accept, I don't accept. We now go to your workings. You move to your working. That will take us to working 4 or working 3. I will just come here. 14% unsecured loan stock. I have issued one for the ventures holder. I will now put it here again. Bank.
So the bank is losing net of 2 million.
It's not left for you now to accept or reject now. Nobody is forcing you.
No, I'm just trying to appreciate. I'm trying to appreciate the question.
Okay.
The bank is, the bank is losing 2 million.
I understand. Now, bank will accept 14% unsecured loan stock that worth 6 million. Like he rightly said, if banks should accept this offer, that means bank will lose 2 million. Again, aside from the 2 million, bank will have to wait for 5 years for repayment. You know, overdraft, you can collect it as it's a short-term loan. Now, they are now saying that, look, that overdraft of 8 million, we are going to cancel it. We are now going to give you unsecured loan stock of 6 million. First, you are losing 2 million. Again, you are going to wait for 5 years before you can get the 6 million. Will the bank accept or not? We don't know. But we are going to treat the reconstruction scheme as given to us by the examiner. Is that point clear, please? We move to note number 5. Note 5. The unsecured payables should be written down by 25%. Immediately move to your statement you are giving. Please be careful. These figure years are for liquidation. If you look at these figures here, 10 million, 5 million, 8.5. You are only going to use this figure if you are talking of liquidation. But now we are talking of reconstruction. Because some might be wondering why we are not using this figure. I will now come here. Unsecured payables is 20 million. The company is proposing to write this down by 25%. Please compute 25% of 20 million and deduct it. Please compute 25% of 20 million and let's have the answer. That will take us to working 4. Working 4. Unsecured payables. I will come here, the book value. Any, I hope you are there.
Yes, I'm here.
Write down. Please, 25%. How much, please? I think that should be
5,000.
Okay, thank you. So less 5,000, we are left with what? 15,000. Thank you. The next note. Our next note. Note number 6. A right issue of 1-for-1 at par to be made on the share capital after the above adjustment has been made. Okay. Oh, Mohammed. Okay, no, the battery is so, and there's no light. You can't plug it. No problem. No problem. You get the video. No problem. Thank you. It's understandable. Now, a rights issue of 1-for-1 at par. Before we go to that treatment, let us explain briefly what is rights issue. Rights issue is the issue of new shares to existing shareholder in proportion to the number of shares currently owned in the company. A right issue. You may note it down. When we get to source of finance, I'm still going to deal with this in your class by God's grace. God's keeping us. A right issue is the issue of new shares to existing shareholders, usually at a reduced price, in proportion to the number of shares currently owned or held in the company. I will explain that. Let's go and treat this right issue. Right issue will affect share capital. Issue of new shares to existing shares. I will now come after the adjustment. I will come here. We have 12,500 shares before, and the Naira amount is 12,500. And I want to do right issue. Rights issue. 1-for-1. For one existing share, I'm going to issue 1 new shares as rights. Now we have 12,500 shares in existence after the adjustment. After the adjustment, number of shares is 12,500,000. How many new shares are we going to issue under the right issue? You can respond via chat. How many new shares? Thank you. 12,500. We are going to issue 12,500 shares. And it's at a par. The par is 1 Naira. The par value is 1 Naira. So we are going to realize 12,500. That means after the completion of the right issue, we are going to have 25,000 shares in issue. And the Naira amount is 25 million Naira. Then the last adjustment, 12.5 million will be invested in new property and plant. We have been working on plant before. Look at working number 1. Our plant and machinery. We have a value of 8 million. Examiner says new investment in new plants and machine, 12,500 investment. That means our plant and machinery become how much, please? Please add these two figures together. What do you have? 2,500.
500.
Thank you. We are done with the adjustments. We can prepare post-reconstruction statement of financial position. We are done with the adjustments. We can prepare post-reconstruction statement of financial what? So I'm going to share another screen. Thank God for innovation. We can do class. We can have our class and we can also use our board. But why is black man not innovating? It's only white man that innovates. What's the problem really? What's the problem really? Zoom. Zoom is innovated by a white man. Why only white man? The class is silent. Why is it that it's only white man that innovates? Okay. I will now come here.
Well, we're worried about we don't have power. We can't buy food. So to innovate is a problem.
That our witchcraft, we use it negatively. Honestly, this thing is actually witchcraft. Our own witchcraft in Africa is negatively. Look at me. I'm in my house here in K2, somewhere in K2 my 12. And different location you are seeing me. The same thing witchcraft we do now. They will calabash and be looking at people in different places. It's the same thing they are doing. That's science. It has to do with some witchcraft. And let's go on, please. All right, statement, you call it post reconstruction. You can always write the heading. Let's go to the statement first. We can always write the heading so that we save time. I have my Naira sign. My Naira sign. 20. I have my 20. I will start with non-current assets. Under it, I have freehold property. The value is now 10,000. Look at your working, it's there. Let me refer you to it. Look at it here. Plant and machinery, 20.5. I'll come back here. Plants and machine, 20,500. Total non-current assets, 3,500. Then I will move to my current assets. I have inventory and work in progress. Go to your workings again. Inventory and work in progress, 13.5. Receivables, 8.5. I will go back. This is 13.5. My receivables. 8.5. Please, total. That should give me 22. Is that not?
Yes.
Then I will now pick my current liability. My current lab. Go to your workings. Look at this working. My current lab. No, it's not here. It should be here. It's not here also. That is unsecured payables. Where is it? It should be here. I look at it here. Unsecured payables is now 15,000. I will go back. I only have one. Unsecured payables. This, I'm shorting it. 15,000. Bank overdraft has been written off. So the only current liability we have is unsecured payable. Please guess your working capital. 22 minus 15. Our working capital becomes 7,000. Is that not, please? 7,000. Non-current asset plus working capital, that becomes 37,500. That is your total asset less current liability. This is your total asset less current liability. Next, I will now pick my, come in please, I'm trying to move this up. I will pick my non-current liability. I can come here. Non-current liability. That is my 14% unsecured loan stock. This is repayable in 5 years. Look at it, please. 14% unsecured loan stock, repayable 5 years. This is a non-current liability. I have two. Please sum up. 6.5 plus 6. That should give us 12.5. Is that not? Yes, that is 12.5. I will come here. Unsecured loan stock total, 12.5. You can less this. You are going to get your net assets. Net assets. The net assets is 25,000. You can close this. You now come to represented by. Represented by. What is the share capital? The share capital.
5 million.
25 million. Your balance sheet balance.
I have a question though.
For why not? You are permitted to ask question now.
In the question, they said they wrote off loss that the company posted. That loss, are we making the assumption that they've already adjusted the equity of the company by that loss? Because I thought that when they said they wrote it off, is it already adjusted? Okay,
thank you. First, we have prepared the statement, we are balanced. Now the question he asks, examiner says write off. Let's go to that note so that everybody will appreciate it. Yeah, this is the note safe. Yeah, the debit balance on the statement of profit or loss written off. Now let's go to it. How much is this? 8 million, Abi.
Okay, it's there.
If I
Okay.
write it off, that means going to become 0. Is that not?
Yeah.
That means it will not appear again on my statement of financial position. Is that not?
Okay, it has been
Is that
treated.
not?
Okay. Yeah.
That means I'm no longer reflecting it here again now. Look at the statement. Are we reflecting the 8 million loss? You just not reflect it.
Yeah, we just ignored it. Okay.
Thank you. You are done with your statement. If you look at solution is also provided in the material shared. We can only take the A part tonight, I know. Look at it. You only need to add these two together. Everything. You are done. You have prepared the statement of financial position if the company is reconstructed. We have done it. That is how the statement of financial position will look like if you reconstruct Diamonds Nigeria Limited. We have only addressed the A parts. I always wish that we can round up the question, but if you are, why is good? Why the digital part helps when you solve question in class? It can consume time. If now I have like 13 students or 12 students online tonight. If I meet you next week now, because the one will be taking, if you are meeting next week and I have like new students joining, that become a challenge. Albeit we cannot go beyond this. It's 11 o'clock. When we meet in our next class, we are not going to look at the B parts. The B part is explain to us if this reconstruction, explain to us the advantages and disadvantages of the reconstruction scheme from the viewpoint of 3 stakeholders. The stakeholders are 1, the shareholders, the secure debentures holder, and the bank. Now, to give you a clue of what you should expect, or you can also look at the explanation, although we are still going to solve it. For you to explain to the examiner, you are going to look at 2 positions. If this company is liquidated, and if this company is reconstructed, we have prepared a reconstructed statement of financial position. Now, you're not going to go to that place, okay? Assuming this company is liquidated and the asset realized, how much will the ordinary shareholders collect? How much will the secure debentures holders collect? How much will the bank collect? That will now give you an insight to know if the reconstruction is good or bad. If the reconstruction is advantageous or not. May God give us a better understanding. Any question, please? All right. Any question, please? I will be stepping out and I will be closing the class. God keep us we meet again. Let's have a blessed evening. And thank you for your time. Eniola, thank you for taking our time to read for us. Thank you. Good night. Let's remain blessed.